First of all, I would like to welcome Sanjay Bakshi sir to this session. Thank you so much, sir, for taking out time from your busy calendar. We have been learning from you since quite long, and you actually are one of those professors and investors who are quite open about their learnings, as well as have given a lot to the value investing community in India. And you being a professor at Flame University, to have you here over a guest talk to talk about a couple of questions which we have here shared on the screen. It is genuinely a pleasure to host you, sir, for the session. And without any further ado, maybe if you're comfortable, we can begin with the Q&A discussion part, sir.
Okay.
So the first question will begin with Yashika Narang, sir. She is our alumni, presently working with Multiply. Yashika, maybe you can begin with your first question.
Yeah, so my first question is on diversification. So there are many companies that enter into new segments to diversify different from their core business, and they end up misallocating capital. As Shyam Shekhar sir also mentioned that diversifications usually fail, but we have which is also diverse in different businesses such as investments, insurance, railroad systems, and utilities. So I wanted to ask you that, in your opinion, what are the parameters one should consider before coming to a judgment that whether the company is operating in different segments is misallocating capital or not?
Okay. Shyam, by the way, is a good friend of mine. I've known him from mid 1990s, and he's right, of course, when he says that most diversifications fail. And I guess he's referring to the statistical odds. After having seen many attempts made by many companies over a course of a career which spans more than 3 decades for Shyam, for sure, I guess he is referring to his own experience and also by whatever he's read about what normally happens, what is the averaged outcome, what usually happens when companies get into diversification attempts. So basically, I think he's referring to the underlying base rates, the statistical odds of success or failure based on past situations, similar situations, in this case diversification, but it also applies to so many other situations like investing in penny stocks. Most penny stocks will go to zero. Investing in very high P multiple stocks, typically they don't work out very well. Or investing in IPOs, or most venture capital transactions are doomed to fail. And there are many industries which are very tough, retail or airlines, for example, where the underlying odds of success are very low. So it's just one, diversification is just one of those examples of situations where the odds of success are very low. But here is the thing, as investors, we have to think about not just the odds of success, but if the odds of success are low and the odds of failure are high, we also have to combine this information with the information specific to the situation that we are studying. So that's exactly how Bayes' rule works. There are two components. One is the underlying base rate. What is the statistical odds of something happening or not happening? And then how can this change based on information specific to the situation that you are studying? So for example, every IPO, every company that you see today, successful company today, was once an IPO company, right? It went IPO many years ago. So the question then becomes is, while it's true that on average, diversifications fail, but what will happen to this particular situation, this particular company's attempt to diversify? And what will happen if it succeeds? Here, you have to think not just about the odds of success, which are dependent, of course, on baseline information, but also the consequences of success if it works out. And we know at least one situation in India where the consequences were incredible. If you recall, there used to be a company called Western India Vegetable Products Limited, which went into an unrelated diversification many years ago, and that company is now called Wipro. So the point here is that while the odds maybe not in favor, and that doesn't mean that no diversification will work. And actually, if you think about this whole thing about diversification, what do we mean by that? What about diversification of a company from a single product to a multi-product company? What about diversification from a single large customer to thousands or millions of customers? What about diversifying away from having a production facility in one location to multiple locations? We all know that all these decisions, when we look at diversification from this point of view, they look like good decisions. They make you more robust. And why is that? Because one bad news can't hurt you much. If you lose one customer, and if you had only one, then you go bust. But if you have thousands, and if you lose one, and that one is not a significant customer, then it's a non-event, right? I think the same logic applies to unrelated diversification. The reason why people get into unrelated diversification, there are multiple reasons, but the logic behind it is that it's a low correlation. It is uncorrelated with what you are doing. And therefore the overall business will not get hurt. If something goes wrong in one vertical, there are other verticals which will take care of it. And that's exactly, by the way, how Berkshire Hathaway has evolved over the years. So my view is that not all diversification decisions should be viewed negatively. They should be viewed more like experiments, and we should go into the logic. Are they related diversifications or unrelated? If they're unrelated, the probability of success is much lower than if they're related. But even if they're related diversification, for example, backward integration, or a company getting into a different affiliate industry. To give you an example, Sandeep, engineer of Astral, moving out from PVC pipes to adhesives and now wanting to get into paints. There is a logic behind it, right? So you have to go into the logic. Balkrishna Industries trying to get into carbon black. People think of it as an unrelated diversification, but it's a critical raw material, and they were worried about the price that was being charged for that raw material, which was in shortage, and they said we'll make it on our own. And in fact, they made more than what they needed, at least for a while. So they actually started selling carbon black. So now a lot of people would think that this is a tire manufacturing company is going into the carbon black business, but there is a logic behind it, because there is a minimum economic size of the plant. You can't make it small enough. You made it large enough to make economic sense. And as a consequence, as of now, the production of that plant, carbon black plant, is large, which is not sufficient for your, which is more than sufficient for your requirements. So you have to sell it in the market. So you have essentially gone into the carbon black business, but not because you originally intended to do that, but you have done it as an outcome of backward integration. So the point I'm making is, just try not to be too judgmental about these things. The moment you hear about the word diversification, doesn't mean it's good or bad. It is specific to the situation that you're studying. Berkshire, of course, is an exception. If you look at unrelated diversification, Berkshire is clearly an exceptional company, but there is again a logic behind it, and they have a very strong internal discipline about capital allocation. If anybody, all of you would have read Buffett letters and his commentary on how he thinks about capital allocation within Berkshire Hathaway, how he charges managers for the capital they use, and he credits them for capital they release, and how there are no cross subsidies and every business has to stand on its own feet. So there is a very rational internal capital allocation that is happening within Berkshire. Now, whether we'll see another such structure, I'm not so sure that we won't. We might. The point is that there are specific reasons why Berkshire has turned out to be an extraordinary success as a company which has become one of the most widely diversified conglomerates in the world. And there's a logic behind it. So I would say that instead of just criticizing diversification per se, one should study deeper and look at the actual logic and then make a judgment about whether it makes sense or not, without losing sight of the point that Shyam made, that look, the statistical odds are not good. Historically, it's not a good idea. And I think specifically when it comes to unrelated diversification, it's not generally a good idea, but that's not always going to be the case.
Yeah, so thank you. So my second question is that I read all of your three and you have wonderfully explained that. We can see the float in many consumer facing businesses like insurance, credit cards, and FMCG. But can you give any example of B2B company or a sector where you might have observed the business sitting on the float?
Yeah, sure. There are many examples, and they not be B2B, they will be not B2C. So, for example, take the example of a company called Rights, which is PSU. It's a consulting company. It's owned by the promoter is Indian Railways. So they do two things. They do consultancy projects and they do turnkey projects, which are projects, specific projects for the railways, building a tunnel or whatever. They get the project from the Indian Railways and they hire contractors to execute the project. But the interesting thing about these projects is the government, or rather the Indian Railways, gives them money upfront. So they get paid upfront. So it's like they get paid in advance, and we use the money to pay the contractors to execute the project, and they keep the commission. Whatever money they earn, their margin, they keep that. So that money is upfront. It's a low margin business, but because there is no capital requirement, it becomes a reasonably good quality business. The interesting thing about the float of the rights business, however, is that they can't use the money for their own benefit, in the sense that if they put the money in FDs, the interest on that FD will be going to Indian Railways. So it is money that you don't have to pay interest on, because in the absence of that money, you would have to borrow that money. So you can't, so it's like a zero cost float. It's not a negative cost float. It's not something that you can enjoy, unlike what you see in the insurance float that Buffett has created over the years. Another company is, again, this is, by the way, rights is not B2B, it's B2G, business to government, because government, in this case, Indian Railways, which is the government owned entity, is the only customer. Another similar company is a company called Cochin Shipyard. Now, this company is, again, it has many customers, but the largest customer is Indian Navy. And one of the big projects that they are doing for Indian Navy is they're building India's first aircraft carrier. If you look at the balance sheet of this company, Indian Navy pays them upfront. They don't have to worry about getting paid from a customer. The customer pays you upfront. So that's another example. Again, this is a B2G. Third one, which is again B2G, essentially is a company called NBCC, which is again a company which is building out various residential projects and other projects for the government of India, including many projects in New Delhi. Government pays them upfront. In the private sector, there are companies like Just Dial. They, again, the idea here is that get people to pay you upfront for listing in their services. The problem in that model for me is that loyalty is an issue, and technology has changed. It's more like a directory service, and people can just Google how many people actually end up using Just Dial. So there is a problem with the model, but that doesn't take away the point that they have floats in the business. Another company which will be B2B, although it's a PSU, is Coal India. Again, they get paid upfront for the coal that they sell to various customers. If you look at the balance sheet, you can make that out. So there are businesses out there which have float, but my whole thought on the attractiveness of float has changed over time, because in today's world, if you look at it, you have businesses. When you have startup ventures today, think of crowdsourcing. You have all these new business models where you're raising capital to build a product which is not yet in existence, about which only a video of the prototype exists, and you are raising money from future customers to build that product out. We know that business model exists, right? Now, what does this mean? It means that this is a business model where the person who is the owner of the business doesn't have to issue equity to VCs. It doesn't have to dilute his ownership stake, doesn't have to go to debt market to raise money, and is effectively taking money upfront from customers. So there are all these new ventures, new kinds of business models that have come up where the customers are paying upfront. Earlier, when I actually wrote about floating with floats and did my talks on floats and moats, at the time, these situations were much rarer as they are right now. So the relative attractiveness of float is still there, but it is not as attractive as it used to be, because there are a whole lot of new businesses which only from the beginning itself start with negative working capital. They have customers who pay them upfront, which was not normally the case. Normally, for a Colgate Palmolive India to get to a situation where its distributors will give it interest-free deposits and pay you upfront, you need to have a wonderful brand and be in existence for a long time before you can command that kind of terms from your distributors. But that's not the case anymore. There are new business models which have come up where from day one, you start with negative working capital.
Okay, sir.
Thank you so much, sir. So the next question is from Pranay Shah. Pranay Shah is our alumni. He's presently working in an investment banking firm named Felix Advisory. Pranay, maybe you can start with your question.
There was one particular article of yours in which Professor famously says that I would like to invest in a company where I get a dollar return more than what dollar I've invested. And he takes an example of Geico Insurance in which he had invested. And though the upfront cost of investing was very high, but the net present value of the returns on that particular investment, he gets his money back. So his logic, his point over there was that some expenses like marketing, advertising expenses should actually be treated as an asset instead of expense, because the value that the company will be generating from that particular expense will be over the years. So then taking that particular point, we have a lot of startups which have been recently listed on the stock market. A lot of them have a huge net loss on their balance sheet. So in that particular point, is it so since these startups have a lot of customer acquisition costs, so is it the right way to look at this customer acquisition cost as an asset instead of an expense for this company?
Oh, that's a great question. And obviously, if you talk to the people in the companies that you're referring to, they will say it's all customer acquisition cost. It's not a P&L item, it's a balance sheet item. They would want you to do that because it makes them look better. And at the same time, if you treat all of that as expense, it will make them look like very fragile, cash-consuming businesses, which may be true, by the way, but may not be fair to some kinds of businesses where there is an argument for treating at least some of this cost, what you call as acquisition of customer cost, as assets. So what are the conditions under which, generally speaking, such outlays of cash should be treated more like an asset than as an expense? So let's just go into the first principles behind it. And let me take the example of Geico. As in auto insurance, there are customers who are accident prone and end up filing a lot of claims. And then there are these customers who are very safe, very conservative, who don't have accidents because they are very careful. And even when they do have accidents, they don't bother filing claims because they will lose their no claim bonus, or the amount is not significant, or they really don't care. So obviously, from a insurance company, auto insurance company's point of view, this category of insurance customers is extremely desirable. Why? Because they're writing checks to you year after year and are not asking for anything back. So it's the most desirable customer for an insurance company is the fellow who keeps paying insurance premium, which tend to go up over time because of inflation, but they don't file claims, because any customer who files a claim is a loss-making customer, simply because the amount of money that the insurance company will have to pay will be several times the insurance premium that the fellow has paid. So obviously, from a business standpoint, the most desirable customer for Geico or any auto insurance company is a customer who is a good customer, the one I described. Why is it good for you? Because they're writing checks year after year and they're like free money. They're giving you money upfront. You don't have to give anything back. Now, acquiring this kind of a customer is extremely desirable. And if it costs money to acquire that customer, which is what Buffett has written about Geico, even though it penalizes the P&L, it makes sense from a DCF standpoint, because an upfront investment burden of acquiring that customer, onboarding that customer, doing due diligence on that customer, the burden, you see, you do an ad spend, you do an advertising campaign on television. Let's say you spend $50 million and you acquire a few million customers, out of which a few 100,000 customers will turn out to be the kind of customer that you want. So clearly, the actual burden on the good customers that you acquired is very high, because the money that you spend on the ad is the numerator, and the number of good customers that you acquire will be a relatively smaller number. So if you look at the per customer acquisition cost, it will be like very high. It will penalize the P&L instantly. But Buffett has no problem, because he's looking at what he calls as lifetime value. And the reason why lifetime value concept is very important, is often connected to customer acquisition cost, is that loyalty. These are loyal customers. They're like perpetuities or like annuities, and they will keep writing checks. And that's a framework we need to use to apply in other business models, including the model that you're referring to think about whether that exists or not. Now, for me, when I look at this, I think loyalty is very important. And as a customer, I am not loyal to Paytm. I love Paytm, by the way, but I'm indifferent. If Paytm is not working, I can use Google Pay. If Google Pay is not working, I can use UPI. And by the way, cashbacks are important right now. Whoever is giving me the best cashback, I will go there. So I'm not genuinely loyal. Zomato and Swiggy are the same thing. Licious and Mitico are the same thing. So the point you have to ask is, how loyal is the customer, and how much he's going to stay with you, and how much he's willing to write checks to you over the long term, forever and ever. By the way, this applies to FMCG companies, right? So if you forget about for the moment new business models, look at established FMCG companies which spend a lot of money on sales and marketing. It could be Britannia, it could be Unilever, it could be Colgate, it could be any of these companies. They spend a lot of money, and the reason is these are repeat customers who keep coming back again and again, and you are getting a bigger and bigger share of their wallet over a long period of time, and therefore there's a lifetime value associated with it. So you're looking really years in, years out. Now, can you say that same thing for Zomato or Swiggy or Paytm or Google Pay or Licious or Mitico? I'm just giving examples. I can't be so sure about it. So you need to be almost sure that the money that you're laying out is going to yield a positive DCF value for you over the long term. And for that to happen, the customer has to be buying stuff from you over and over again as a loyal customer, which means he won't be tempted to go to somebody else if somebody else gave a better deal, which is not the case right now in e-commerce, right? In e-commerce, customers are not loyal. They are going wherever they get the best deals. So the loyalty is absent. So that was one part. The other part here is that there is inherent fragility from negative free cash flow, which is what I think you implied. Forget about accounting, forget about P&L, forget about whether they treat it as an asset or as a expense. At the end of the day, it's cash outlay, and on the cash flow statement, they end up showing up as businesses that are consuming cash. So if you look at Geico, Geico generates cash. If you look at Unilever, Unilever generates cash. Colgate generates cash. Britannia generates cash. So businesses that at the aggregate level generate a lot of cash, and in that situation, they use some of that cash to try to acquire customers, some of them who turn out to be loyal, is very different from a business that is inherently consuming cash at the aggregate level and is always dependent on the kindness of strangers to raise that cash. Those strangers could be debt markets, could be equity markets, could be VCs, could be private equity capital. And the problem with that sort of fragility is that capital markets are not going to be friendly towards you all the time. So it's like oxygen. You need, if the oxygen is missing even for a few in the context of companies for a few months, you're finished. And that seems to be happening with some of these companies out there. Capital markets are not very friendly towards many of these companies right now, globally speaking. So you cannot ignore this fragility. The other third problem that I see in these business models is the money that you're spending. You have to be very careful about distinguishing between, are you doing it for aggressive reasons or for defensive reasons? If you are, for example, and the management commentary will tell you, if you have to spend this money, all this money, marketing, ad, whatever you call, people call as customer acquisition cost, just to maintain your market share. And if you don't spend it, you lose market share. If you do spend it, you only maintain it. Then it is an expense. You should treat it as an expense. You should not treat it as an asset. I mean, you only have to look at the con call transcripts of Matrimony. I was reading them recently. And the people who run that company say, look, we have to spend this money on marketing because the biggest competitor, to be Jeevan Sathi, Shadi.com, I don't know, they are spending more. So they are spending more. I got to spend. If I don't spend, I lose market share. If I spend, I only maintain market share. And that's a clear indicator of the nature of competition and the reason why you're spending this money. And it is not for growing market share. It is not for growing unit volume. It is just staying at the same place, which of course means that it is an expense and not an asset.
Sir, sorry, I just had one follow-up question here. So in case, let's say, if we take a look at it from a perspective of maintenance CAPEX perspective, right? A lot of businesses conduct maintenance CAPEX to maintain their existing production capabilities. But while actually considering it as one could make a similar argument that they should also be considered as a expense rather than, capitalizing it on further on the balance sheet front.
Well, that's absolutely true, because again, that's a complex question. And when you talk about maintenance CAPEX or anything to do with maintenance, you see, the thing is, we talk about accounting and we have all these labels of assets and expense. While these categories are important, what is important to understand at the higher level is that they're all cash outlays, right? You're spending money, it is going out, you're writing checks. Now, the question becomes, are you doing it for protective reasons, or are you doing it because the business can grow and prosper and become better, and it can build a bond with the customer, it can grow its market share, it can hurt competitors? So those are the questions that you need to answer. Now, as to your specific question on maintenance CAPEX, I would take the example of a situation where a business is fixed capital intensive and it has a lot of fixed assets, which will get obsoleted over time, which will get depreciated over time, and which will need to be replaced. And you are using historical cost accounting. So you're just charging off on the P&L depreciation, which will bring down the cost in the books to almost zero over a period of 10, 12, 15 years. But the replacement cost of the asset, whenever it needs to be replaced in nominal rupees, will be much higher simply because of inflation, whenever the life of the asset runs out. Now, under those circumstances, by the time you have to replace that asset, the cost will be much higher than what it is, which means that the amount of depreciation that you charged in the books and brought down the aggregate profits of the company to that extent and retained that money in the company and not paid out as dividend, because dividends are paid out of PAT, then even after having that money retained in the company and put in fixed income securities, the money would not have appreciated to a level which will be sufficient to pay for the cost of the asset after considering inflation and replacement cost, which means that you overstated your earnings in the past. So again, this is not the right place for me to explain this. I don't have a board. I can do this on the board and all that, but I think hopefully you get the point here. Then when you combine original cost accounting, high level of fixed assets, and inflation, you almost certainly end up with owner earnings being less than reported earnings. But the key thing about the whole thing is not just about maintenance CAPEX, but also maintenance working capital, which is very important for people to recognize, and something that is been highlighted by Warren Buffett in a few of his essays. And I think it's completely missed by analysts. And let me give you an example about that. So imagine that there is no unit growth in the business. You're still selling 100 units of whatever you are making. You made 100 units of your finished product, 3 years ago, 2 years ago, 1 year ago, and today. So imagine there is no unit volume growth, but there is inflation. Now, if there is inflation, to make those 100 units, you need maybe 30 units of a raw material. The raw material price has gone up because of inflation. So you have to have more inventory. You're carrying inventory of raw material in your books. That raw material will make up finished products. That finished product will become receivable. So even though you're selling the same number of products, you will have more inventory and more receivables on your balance sheet simply because of inflation, not because of unit growth. So there is a difference between the working capital requirements of a business going up because it's growing, it's adding capacity, and we know that we keep monitoring growth in the company, physical growth in the company with growth in working capital, and we know that there is a correlation there. But over here, I'm looking at a steady state business which is not growing and still seeing in nominal rupee terms increase in receivables and increase in inventory. Now, what does this mean for us? It means that the working capital requirement measured in dollars or rupees has gone up. That means the business is asking for more money just to stay where it is. If you don't provide that capital, you will not be in a position to carry that much inventory or make that much stuff and sell. So you'll start shrinking. So just to stay at the same level, you need to deploy more working capital. Where will that money come from? It has to come from either equity or debt. So if you have more debt, then there will be an interest expense on the balance sheet. If you have more equity, then there'll be dilution. So either way you look at it, it's not good. Your working capital requirements, especially in current times when we are experiencing inflation, many working capital intensive businesses would see a jump in their denominator in the ROCE business. So even if the reported earnings prior to interest is unchanged, the capital employed will go up simply because the working capital requirements have gone up. So I'm just giving you an expanded answer to the question that you asked. Your question was limited to maintenance CAPEX. I've also added the section on maintenance working capital. So these are important considerations to look at when you look at the economics of a business.
Got it, sir. Thank you so much, sir, for such an elaborate answer. So we'll move to the next one. Samyak. So Samyak is our current FinPlus batch student. Samyak, maybe you can begin with your question. Samyak, you are not. Samyak, you are. I think there are some audio issues at your end.
Maybe you can read his question out. The question.
Sure. Samyak's first question is: given the multiple moving variables in valuations, how do you analyze margin of safety inherent to a stock? Based on his limited understanding, valuation at debt capacity level is utilized only in extreme bear markets where there is indiscriminate sell-off across the board. What are your views on this?
Yeah, so there are two questions here. Basically, given the multiple moving variables evaluation, how do you analyze? So margin of safety, if you go back to the concept of margin of safety in the way Graham described it, and he basically had two key sources of margin of safety. One of them was you have calculated value, which is much more than the price that you're paying. And his calculation of value was not DCF based. It was based on liquidation value, asset value, replacement cost, all of those things, which may not be as relevant today as they were at the time when he wrote his books. But there was a second source of margin of safety, which is that you have estimated the earning power and compared that with the stock price, and that relationship gives you a number which is much more than AAA bond yields. Thinking about it like a business, you can get into a business and lay out $100, and if you put your money in a AAA bond right now, maybe you can earn $7 or $8 on a pre-tax basis in a AAA bond. But if you could earn 12, 13, 14 bucks on a pre-tax basis in a stock, maybe not right now, maybe this year you'll earn only 10, maybe next year you'll earn 11 and then 12 and 14. Then over a period of time, the earning power of the business that you are buying into is more than what you would have got if you had put that money in a AAA bond portfolio. Because if you put money in AAA bonds, that the earnings are never going to grow, right? They are going to remain the same. And if there is some problem with even a single bond in the portfolio, your earnings will actually be lower. And no bond is going to pay you more simply because the company is doing well. They only pay you the contractual rate of interest. So there's a cap on how much money you can make. So he was just comparing that, look, you can always put your money in bonds, on very high grade bonds, and you know how much money you're going to make in that. The best case scenario is known. But if you put your money in a bunch of stocks and at the portfolio level, if the earnings of those companies as compared to the current valuation market price of the stock of those companies is giving you a number which is at least twice of AAA bond yield, could be 150% of bond yield, it could be even 100% of bond yields, but growing over a period of time. That's another source of margin of safety from a very purely business standpoint, that you're getting into a business where your starting yield itself, earnings yield, is in excess of what you can get from a bond. Now, that's a good position to be in from a business point of view, considering the fact that you have a venture capital market and you have a private primary market where companies are being valued. When they don't even earn anything, they get valuation. So we are actually talking about companies that are already in existence, are making money, and the money that you're laying out to buy that business, if you take the current market cap, will give you an earnings which is more than what you will get in a AAA bond, and the earnings are going to grow. That's a phenomenal source of margin of safety, right?
Yes.
Now, exactly the same point came out in the debt capacity bargains, which I popularized with a few lectures on that subject. But the idea is the same, that that there are times when a company may be selling at such a low multiple, a debt-free company may be selling at a so low multiple of its earning power that you can effectively split the total earnings of the company into earnings attributable to a bond component, which can be independently valued, and that value alone is more than the value of the whole company. So that was the mathematical sort of a demonstration of extreme cheapness. And you're right about mentioning that this happens only during major bear markets. But that's not the only source. Debt capacity bargains, when they exist, are at extremely low PE multiples, but that doesn't mean that there is no margin of safety at even higher valuation. You can look at valuation from the perspective of low price in relation to earning power. Basically, start thinking in terms of earnings yield as compared to bond yields. The difference between earnings yield and bond yields makes a lot of sense from a business point of view. Because what that means is that if you were to go into a business which was only paying you a fixed return and no more than that, you can value that. But if you're getting into a business which is going to give you a return which is equal to or more than what you get in a bond, and then it's going to grow over time, then you can, that it's going to be much worth a lot more than the bond component alone. So I think that's another way of thinking about it. There are many ways of illustrating this, talking about not paying anything for growth at a reasonable price and so on. But essentially, the idea of margin of safety is should be seen from people who don't want to get into DCF, formalized DCF, should be seen much more from the point of view of earning capacity of the business in relation to current stock price as compared to AAA bond yield. And if you have that judgment of figuring that out, and there's a big difference between these numbers in terms of the earning power is much higher than AAA bond yields, even if on a forward-looking basis, then you have a source of margin of safety. It may not work out in your favor in a specific situation, but if you keep doing this at the portfolio level, your portfolio will be very conservatively priced and should do well in the long run.
Yes, sir, understood. I hope I am audible now.
No, you're not. Very
Actually,
low.
Your voice is very weak. Anyways, let me begin with his second question, sir. So his second question is around winners. Like, there are outstanding businesses, and in one of your articles you mentioned that never ever, no matter what, you should let go of such outstanding businesses. But His question is, markets can stay rational for a really long amount of time, and for a new investor like himself, maybe perhaps isn't it better to rotate capital from such outstanding businesses which still say undervalued for a really long amount of time, and rotate it to some businesses which might actually get recognized?
The second question is, it depends on the investing style and your long-term expectations. Some people, there will be errors. So if you sell and if you rotate and if you go into something else which you think will do better, after 5 years, you may come to the conclusion that it would have been better off not to rotate. It's very hard to be able to predict these things. What we do know is that truly outstanding businesses, the kind that Philip Fisher wrote about, they tend to become more and more valuable over time, even though there are periods during which they don't do anything. So, the stock does nothing. And the reason is, of course, the multiple has gone up. It takes, sometimes the business will do better than the stock. Sometimes the stock will do much better than the business. But if your eye is on the very long term, and if you think that the earnings 5, 10, 15 years from now are going to be much, much higher than what they're right now, then even if the business looks expensive, if you don't have a problem in staying invested and earn zero returns for 3, 4, 5 years, then you should stay invested. I'm not saying that you should not have a problem. Maybe you should have a problem because you're managing other people's money and they have expectations, or maybe because you are hungry to become rich and there are other opportunities that you think will give you compounding. The problem, the key attraction of staying invested in an outstanding business is to limit reinvestment risk, because the risk is that the money is, you sold something and you will end up replacing it with something that is not outstanding. Now, but it's very hard to predict in advance whether the judgment that you made is right or wrong. You will not know the answer. For this is the problem in value investing. Whatever you do, whether it was the right call or not, you will not know the truth many years down the road. And even if you know the truth many years on the road, you still don't know whether it was a bad outcome of a good process or a bad outcome of a bad process. So life is not long enough for us to have enough experimental data that can tell us about these things. So it is very personal preference thing. And by the way, your own personal preference will also change. So if you're hungry right now and you think there are opportunities to jump in and out of stocks and do well and compound capital without being invested for long periods of time, that may well be your style of investing, but I can guarantee you this will not remain the same forever. You will change over time. This is what has happened to most people that I know. It's certainly the case with me. But if you don't have the ability to stay invested for long period of time with negligible returns, even negative returns, then maybe it's not for you.
Probably I will just try last time if it's audible.
Yeah, it is.
Better now.
Oh,
yes.
yeah. So I will move on to my next question.
Mm-hmm.
It's on how do you manage availability bias to ascertain which data needs serious consideration versus which needs to be ignored. Given the volume of data that we have today, I would like to know your personal experience where a data point was initially overlooked by you, but which later turned out to be of quite significant importance.
Yeah. Okay, let me tell you a few things. Investing is a probabilistic game. By definition, everything is not going to work out. And there's a nature that things don't work out. You start doing post-mortem. That's the nature of the game. You're not going to win. It's going on the pitch to bat. You're going to get out once in a while. So keep that perspective in mind when you look at, when you're trying to do a post-mortem about something that is not worked out, whether it is not worked out because it was a bad outcome of a good process or a bad outcome of a bad process. To be sure, processes need to be validated and revalidated and examined and changed in light of errors that come to light. So you have to be very careful about being able to tell whether a bad outcome was because of an error, which can be fixed and therefore it should be fixed, or it was just a statistical outcome of a process, which is a good process. And it's not easy to do that, by the way. So it always comes with experience and a lot of reflection and introspection. That was one. Second is that when you look at data, availability bias it's a key problem. And by the way, it's a key problem not only before you invest, because you have to think about what are the key factors, what is relevant, what is not relevant. Do I look at quarterly result? Do I look at long-term results and so on? And then it becomes an even bigger problem after you invest, because your investment doesn't stop post investing, initial investment. You have to revalidate your hypothesis. There are new information coming out. The hypothesis may be strengthened or weakened in light of new information that comes in. And it's actually tougher after you invest, because now it combines with commitment bias. You already invested, so there is commitment there. And then now this new information is coming. You have to figure out a way to deal with it. So it is a key problem, no doubt about it. Now, as to the question about what data is important and needs serious consideration and which data is to be ignored, is about signal and noise. A lot depends on the style of investing that you're following. So just to give you an example, within the field of value investing, you could be doing statistical bargains, buying cheap things. You may be buying things that are statistically cheap. And there are many ways of defining what is statistically cheap. It could be low P multiple stocks, it could be low stocks in relation to asset value. It could be great businesses which are out of favor and are selling at a lower end of their historical valuations, where the future can be, the historical valuations, history can be relied upon to think about the future prospects of the business and so on. If you are doing the statistical bargain hunting and you are buying a lot of stocks, you're buying 30, 40, 50 stocks in a portfolio, then diversification is a huge friend of yours, which means you don't, so a lot of things you don't have to think about. You are just looking at statistical cheapness of the business. And therefore, what is noise for you could be signal for a person who is thinking of buying that business and putting a lot of money behind it. For him, it is very important to think about many factors, thinking about the business, the management, the value. Of course, valuation is important across the board in all value investing style, but the quality of the business, the quality of the management, the operating skills, the management, the capital allocation skills, and so on and so forth, the entry barrier, the pricing power. There are all sorts of things that you have to think about when you are investing in high quality businesses, which you don't have to think about when you're buying statistical bargains. So again, one man's noise is another man's signal. So that's the brief answer to your question. You have to think about what exactly is it that you're trying to accomplish here. Now, as to the second part of your question, asking me from my own personal experiences, again, I'm only referring to, when you're doing statistical bargain hunting, the big problem that you're going to have is you're going to end up with value traps, things that remain cheap for good reasons. But let me talk about things that were overlooked but later turned out to be important. So a few things from my own experience of deep introspection, when I look at the history of investing in businesses perceived to be of high quality, are as follows. One, earnings that were high for temporary reasons but were thought to be permanent. And I'm not talking about temporary shortages. I'm talking about a business getting a lot of order and a big order book and developing customers which have high switching costs, and they have moved away from other customers because other competitors had governance issues, and as a consequence of that, the business shifted to the company that you were looking at, and as a consequence of that, the business started doing very well and it looked attractive, and you sort of projected that into the long into the future under the assumption that the competition that is lost out because of governance issues will not come back. And that was wrong. Again, it's about the permanence of things that you could go wrong on. The other thing that could happen is that you're overemphasizing management capabilities. Management has done something in a field in the past, and you got into the halo effect sort of thing, that you started double counting the management attribute. The numbers are already telling you that they are doing very well, and then you add on top the capability of the management, and therefore overemphasize the management. When they try to do something else, they were not as successful, or there was basically overconfident about the capabilities of the management in solving complex problems. So that was the second category. The third one could be that you invested in a niche business and it prospered because it was a niche. But as the niche business grew, there were all sorts of competitors who were not looking at that space in the past because it was too small, started looking at it now, and new entrants have come into the business and has materially impaired the earning power capability of the business that you were looking at. And that has happened in the sense that it's important to recognize that sometimes growth can actually hurt. Growth of the industry can hurt the economics of the industry. If it is too small and it has place for only 2 players or 3 players, then those 3 players can prosper so long as the industry remains small. And by the way, this is the problem with many companies. If you look at some of these micro cap companies, they seem to be doing very well for now. And the reason why they seem to be doing well now is not because they have a deep entry barrier or something, some capabilities which can't be replicated, but the big guys have not paid enough attention to your industry right now because the whole thing is too small for them. The moment it becomes large enough in terms of size of the opportunity and it scales, then new entrants will enter. And that's a mistake that I see quite common in investing in smaller companies, because they are successful because they are small. As they become larger, they will attract more competition. Again, the point becomes obvious that it's all about entry barriers. You think there were entry barriers, but they weren't. It appeared. The thing is, when you are studying a company that is doing very well, it has high ROC, it has high ROE, it has very low debt, it has margin profile, it is gaining customers, you tend to think things will get only better, or at least they will not get worse. You don't think that, well, they are doing so well that it will attract competition, and as a consequence of that, they will start doing worse. The enemy of success is success itself. So that's very counterintuitive and very difficult to overcome that bias. So that clearly has been one of the situations that one has to deal with.
Understood, sir. That very well answered my question. So my last question is, in an owner-operator kind, owner OO3 is characterized to be very aggressive when it comes to expansion, and he is likely to make large gambles and does not take minority shareholders' interest into consideration. So in this regard, I had 2 questions. First, it's generally seen that minority shareholders are themselves unaware as to what's in long-term benefit for the company, and their judgment is generally generally driven by the market sentiments. So how should one analyze whether the minorities are exploited by the management or not, since the management could make a decision which is a pain today and gain tomorrow kind of proposition, but the market is still unconvinced for that. So how do we analyze this
I
thing?
don't want to mix up markets, what market thinks and how you should think. You should try to have an independent mindset. These market sentiments is not something which is at least a field that which is open for analysis. Business analysis is not the same thing as market analysis. Let's focus on business analysis, right? So your question is about an owner operator who's very aggressive and comes to expansion and is likely to make large gambles. I don't like the term large gambles, because the word large gamble itself means that the fellow is a gambler, which is the opposite of conservative behavior. And large means that large gamblers sometimes win and they become very rich, but most large gamblers end up blowing up, right? So large and gamble, both things when you combine together, is a no-no from a risk management point of view. So from observing the graveyards of companies to find that what they did and how they blow up. If you look at the most common cause of failure, you will find large gamblers very much over there. So what you have to think about here is the quality of the decision that the person is taking, whatever the decision is. So the track record is very important. If the person has a long track record of making judgments, and those judgments are conservative, and the process is not, don't focus on outcomes, focus on the underlying process. If somebody got lucky by betting the bank on a new project and the project worked out very well, obviously the fellow will be profiled in business media and will be portrayed as a hero, and the market sentiment will be excellent. But was it good due process? Did it make sense to spend so much money? Because he's going to do it again, right? If that is his nature of betting the company on a single large project and funding it with a lot of borrowed money, basically compounding risk on risk, if he has no sense of risk management or position sizing, how to fund a project, how to think about the consequences of failure, then it is the opposite of what Warren Buffett makes large bets, but none of the large bets, even if they go wrong, the worst case scenarios have zero probability of destroying Berkshire. So if you have a guy or a girl who has that mindset of being opportunistic, taking chances, doing experiments, making bets, but calculated bets, so that if the bets pay off, they have asymmetric payoffs, the outcomes will be extraordinarily good. But if they don't pay off, even if the probability of that is high or low, doesn't matter, the worst case scenario, forget the probability, if it transpires, will not destroy the company or will not destroy the earnings of a company meaningfully. As a, if things turn out well, if you have bad luck or bad judgment or bad execution or cost overruns and time overruns and what have you, things happen, right? If those things transpire and the consequences of your going wrong are not going to be devastating, then you're onto something. But if you find somebody who has the growth mindset but is willing to grow at the cost of anything, and we have some people who are doing that right now, and we had past people who did that. If you look at previous list of people who have gone broke in the last 15 years, a lot of people will be the ones who are indiscriminately growing their business without any consideration about risk management. Look at the track record, look at the process of the decision, study their decisions from a detached point of view to figure out that, is this a good process? Is he thinking about risk as you would want somebody to think? And if the answer for that is no, then clearly you know that you're dealing with sort of a big gambler.
Understood, sir. Thank you. Thank you very much, sir.
Thank you so much, sir. So the next question is from Jayati Vyas. Jayati is our current Finbridge batch student. Jayati, maybe you can start.
Good evening, sir.
Good evening.
Sir, in one of your blog, you wrote about the ideology when you constantly keep pouring in and pouring it in, and where there is no cash ever comes back out of it, or the choices you made failed to keep a pace with a down accelerator called inflation. And there is 100 of them, and we face miserable choices. Either one should stop investing in such companies or pour more and more capital and still make no real profit out of it. So my curiosity is around the same only. What should one do in such situation when we come across the stock that may perform well in short term due to cyclical effect, in long term there is the business dynamics are very poor?
Sure, that's a good question. Again, I've answered part of it in the earlier question about working capital and maintenance capex and role of inflation on owner earnings, and how you have to keep putting more and more money just to stay at the same level. Your unit volume doesn't change, just to maintain the same unit volume. And to an even earlier question, I had talked about how companies have to spend money on marketing expenses, ad expenses, just to keep their customers, because the competitors are spending even more. If they don't spend it, they lose it. So again, the escalator metaphor is very valid. It's not just on inflation, it's also on competitive attacks. And businesses are required to spend money, cash outlays, just to protect their turf, so to speak. And of course, that's not a good situation to be in as a business person. But the thing is that we are although it makes a lot of sense to think as a business analyst and to put yourself in the shoes of the entrepreneur who's running the business, the reality is that you are actually have the option of buying the stock or not buy the stock. So it depends on your preference. If you are an investor who wants to invest only in the highest quality businesses, then this filter that you have no real economic earnings, or economic earnings are much less than reported earnings, or you have to keep pouring money over and over again and it never comes back, you never see it, there is no real free cash flow or actual earnings that will come back to you, you may decide then this is a good filter for you to what to avoid. But and that's Philip Fisher, that's the way Charlie Munger would like to invest. But Ben Graham, who's also a value investor, would say that a bad business need not be a bad investment. It depends on the price. So even a bad investment, in fact, if you read his books in, I think in security analysis, he has a section on investing in the highest cost producers. So he basically gives you an example of an industry, which is a cyclical industry, where there are three companies. One is the lowest cost producer. It has a debt-free balance sheet. It has the lowest cost of production, and it works out the P&L. So it has the highest margin and in a PBT margin, PAT margin, and there is no interest expense. So it has the highest margin. And also because the cost of production is the lowest, so the price charge is the same for all the three guys because it's a commodity industry. So for the same business unit volume, one guy makes more money on a per on a PAT margin basis, and one guy makes the least money. The guy who makes the least money is the guy who has the highest cost structure, has got the most levered balance sheet. So he has a big interest expense on the P&L, which is not there with the lowest cost producer, and he has a higher inefficient cost structure. Therefore, his labor cost, his raw material cost, his ad cost, his freight cost is much higher than that of the most efficient player. Therefore, the margin, gross margin is low. There is interest expense, and therefore the PAT margin is negligible, if anything. But the investor has a view. The view is that the commodity that this industry makes is going to become, is going to experience shortage, and as a consequence, the price of the commodity is going to go up. And he works out mathematically, if the price goes up by 15% or 20% or 30%, what would be the impact on the P&L of the highest cost producer versus the impact of the P&L of the lowest cost producer? Obviously, the lowest cost producer, if you work out the numbers, all three companies will see growth, the medium, the lowest, and the highest. But the maximum jump in the per share earnings earnings will be that of the highest cost producer and the most leveraged producer. And he says, paradoxically, this company is the one you should own. If you are, so basically it depends. If you are investing in cyclicals, if you are investing in turnarounds, if you are investing in certain situations, then you don't have to think about maintenance CAPEX, owner earnings, a whole lot of things. The whole framework of investing in a higher quality business requires you to focus on variables which are almost always insignificant for, again, a different kind of a value investor who's investing for a cheap price, because for him the cheap price is his friend, or the prediction about the price of a commodity is his friend, or his prediction about his view on a certain industry going through a period of an upswing is a friend. So if you're investing in a mean reversion sort of situation where bad companies will turn out to be good companies over a period of time, then you can spend a lot of time thinking about what will happen to the earnings on a per share basis over a period of time, and how that will be valued by markets as they grow like crazy in the next few years because of cyclical upturn.
Thank you so much. So my next question is, in one of your video, to mention a quote about of Peter L. Brinson, in which he stated that riskier movement is when you are right, and that's when you are the most troubled, because you tend to overstate the good decision, and once you have been right for long enough, you don't even consider reducing your winning position. They feel good. So my question is regarding the same only. Can you please suggest any framework around the same, how we can go about avoiding the mistake?
So there are two ways. One is a hard way, one is a simple way. One simple way, the only thing is that you can create that framework, but you don't have to stick to it. The hard part is sticking to it. So make it unemotional, come up with a number that if a certain position becomes more than X% of the portfolio, you will pay around the position no matter what, no matter how, because you don't want to end up with a situation where something goes wrong and you lose a lot of money. So that could be 15%, 20%, 30%, whatever the number is. It has to be a number significant enough. So you have the flexibility of letting a position run up and make an impact on your portfolio. But then you also have to make sure that, because obviously the money that is coming in, the mark-to-market profits that are coming in, they'll make you feel very good about it. The dopamine will play out and make you feel that party the shuru hui hai and things will only get better. So if you have a predetermined number or a percentage of assets or percentage of portfolio or position limit, then the only thing that remains is that you will disregard whatever you're feeling right now and execute what you had planned to execute in such an eventuality as it has happened. By the way, it's a good problem to have, right? To have a business which goes up in value, so becomes a very large percentage of a portfolio and you pare it down. Of course, 5 years down the road, you may feel that ye kya kiya maine, it went up another 3x or 4x or even 10x. But you see, it is what it is. Life only plays out one iteration. There could be other iterations which you don't see. It could have turned out the other way also, right? So if you're focused on protecting your capital, then you have to make it sort of almost algorithmic, that it is something that I will do no matter what. That was one. The second is about things are doing well and tends to make you overconfident. Clearly, that's a tendency. Two things. One is keep challenging your assumptions. Is it still a good business? Is it still an outstanding management? Is the valuation not extreme? Keep asking those questions, and if the questions give you tough answers, then you know what you have to do. And the last tip I can give you here is respect mean reversion. Mean reversion is a very powerful model, and it's applicable in the world of business. Any company that is going through a period of prosperity for a long time, it's almost set for a reversal in its fortunes. I'm not saying it will get destroyed, but it will experience a period of adversity. There will be a bad period. It is inevitable. If you look at the trajectory of all companies, and therefore you got to understand that these things will happen, and you got to think about what will happen when they happen. If you think that it doesn't matter long term, I'm only focusing on the earnings 10 years out, then even if bad things happen in the interim, I don't care about market valuation, so be it. But if you are worried about market valuation, if you are worried about drawdowns, if you are worried about a 50-60p multiple stock which is growing its earning at 30% per annum and suddenly sees a flat year or two, as to what will happen, if that bothers you, then you know what you got to do. You got to make sure that a long period of prosperity is much more likely to be followed by some period of adversity, because that's the way life works. Whether it is human beings or businesses, that's the way it is. You are living in an uncertain world, and if you're priced for perfection, that's the other thing. Markets tend to also extrapolate recent excellent performance into the future, and it gets reflected in not just earnings growth which has been projected, but also the multiple re-rating that has happened. And that basically means that you are priced for perfection. And that's a very interesting phrase to keep in mind, that am I priced for perfection? If something goes wrong in a margin, business volume contraction, market share contraction, competitive attack, management mistakes, misallocation, I mean, there are so many enemies of earnings trajectory that can happen. We've seen, all of us have lived through a period of extreme uncertainty over the last 2.5, 3 years because of COVID. These things happen, right? Shit happens. We have to think about what will happen if something goes wrong in in this trajectory that is being implied in the market valuation. And if that bothers you, you know what you have to do.
Thank you so much, sir. Jayati's third question is actually covered in your previous answers. So we'll move to the next one. Azeb. So Azeb is our current FinPlus program student. Azeb, maybe you can.
Yeah, thank you. Good evening, sir. It's a pleasure to have you with us. My question is regarding one of your sessions on investing conclave, named fragility and optionality in business models. In that session, you had mentioned that the companies that have a higher level of debt on their books are mostly fragile. So if we consider a construction company that usually operates on higher level debt, so can we say that we have to avoid those companies, or can we create a framework around such companies? And secondly, you had mentioned that suppose a company is mostly dependent on one of its buyers, one of its customers. That is also a signal of fragility. So suppose in an EPC company, suppose an EPC company gets most of its revenues from governmental projects like building of roads and highways. So can you give a summary of how can you create a framework around analyzing these companies?
So there are two ways of dealing with this. There's a good, excellent question. And I mentioned that in my talk as well. So one is that, okay, I don't want to invest in fragile businesses. That's fine. You may decide only to invest in businesses that have been around for a long time and are not fragile, which are built to last. And there is a way to invest in those as well. But that's not the only way, by the way, to invest. But the point is that if you want to do that, fine. You don't have to invest in fragile businesses if that sort of is not for you. But that doesn't mean that it's not for everybody. You see, now let's talk about how to go about investing in these businesses. The way to do that, I think, is to remember Buffett's quote on this, which is that a business should be viewed as a movie and not as a still photograph. So all the examples that you mentioned right now are examples of fragility, whether it is customer concentration risk or whether it is balance sheet quality risk. And if you think about this for a moment, if you look at all successful companies today, whatever, look at Wipro, look at Infosys, look at any company out there that is very prosperous and very profitable and has created a lot of value, think of its origin. Think of when it started. All businesses, when they start, they are fragile. There is one idea, there is one customer, there is 3 employees, there is one plant. If you think about it from the point of view of all these businesses that have been around for a long time, when they started out, they were all fragile. They all had all these problems that you're talking about. They had fragile balance sheet. Maybe they didn't have a lot of debt, but they were small companies, and many of them were funded with, in today's world, at least we see a lot of these companies which are funded with private equity capital or venture capital, and they have made promises to these people, and it's not permanent capital. It has to be, they have to get an exit in public markets. So there is all this source of fragility that is existent in business models. The question is not what it is now, which is the photograph, but what it will be 5, 7, 8 years down the road, which is the movie. You talk about construction companies. So in residential construction, you have float. That if you are a conservative builder and you're not into land bank acquisition and so on, you are launching a project, you are selling it in advance, you get money upfront from the customers, and then you deliver the project. It's not as fragile as it appears. Even in commercial construction, I would give an example of a company that I was involved with years ago. It's called Nesco, which is a company which owns the exhibition center in Goregaon in Mumbai, and they have a commercial building. So they have this exhibition, and they have this land which they had inherited, and they have a lot of space over there, and they have built towers, commercial towers, 1, 2, 3, 4. And the way commercial buildings work is that it takes time for you to build it out, then you have to lease it out, and people pay you advance rent and deposits. And once you build it out, it starts generating a lot of cash, because all the investment is upfront, all the cash outflows are upfront in the money spent on maintenance is not much. Even that is recovered from tenants, and the tenancy contracts have escalation clauses and rents are going up, and you have interest-free deposits. So the cash flow of the exhibition business was used to create or modernize a tower. Then the cash flow of the tower 2 was used to build tower 3, and tower 2 and 3 and exhibition business cash flow was used to build tower 4, and so on and so forth, without taking any debt. So what the point is, you've gone from 1 building to 4 buildings, you haven't taken any debt, and you have used the money judiciously, which has been generated by your existing businesses to create this. So again, if you look at the trajectory of businesses over a long period of time, they go from one product to multiple products, one geography to many geographies, customer concentration risk going down, and so on and so forth. So think of it like a movie as to where it is going. And if you are looking at the movie and you like the movie, then you may decide to handle you're very attracted towards that. Even though it is fragile right now, it is moving towards robust, and hopefully it will become anti-fragile at some point of time. If a business is moving from being fragile to becoming robust, you may decide to invest in that business simply because it is becoming better over time. So there's only improvement happening, right? So that means the value should go up over time, right? Not just because of earnings growth, but also because it is becoming more robust. Because it can't get hurt because of some unfavorable developments 10 years from now, as it will get hurt today. So if you think that is playing out, then absolutely it makes sense for you to look at those businesses. So look at the trajectory, look at the possible outcomes going into the future, and as they get better over time, they do become attractive. You may handle the individual fragility existent right now by having a smaller size position in that business. It's a tiny company on the way to becoming a larger company, but it is tiny right now. And tiny companies as a class are riskier as compared to larger companies, other things remaining the same. So you may decide that, okay, I want to put a smaller position size in this, and I will monitor how this is growing or getting better over time. And as it gets better over time and the valuation is still compelling, I will add to my position. So I think that's the way to do it. Position sizing and the journey. These are the two things that you have to think about.
Thank you so much, sir. So Dhruv Doshi, we'll begin with your question. Sir, Dhruv is our current FinBish program student. Dhruv, maybe you can choose one question and ask him.
Yes, sir. Good evening.
Hi, Dhruv.
So actually, I had read your leverage promoters, hemorrhage stockholders law. So there are many cases where promoters have pledged their shares and caused wealth destruction for their stockholders. And promoter pledging is touted as very big reason for some serious destruction of wealth in business. For example, Geo Yes Bank. But at the same time, some promoters pledge their shares and use that money to develop their business. So how do you analyze whether it was a correct decision taken by the promoter to pledge their shares or not? And as a follow-up question, so can you explain what is your management analysis checklist? So what points do you keep in your mind while analyzing the management? And so one more, like, how can one differentiate between judgment error that the decision didn't result in desired outcome versus the intentional decision for taking benefits outside the listed company by the management?
Okay, so there are many questions here. I'll try to answer them. So on the first one about pledge of shares, you're right. Not all pledges are bad. If a guy pledges his own shares to save the company, which is owned by him and a whole bunch of other stockholders, how can that be bad? It only demonstrates skin in the game, right? He's putting everything. He's putting his own net worth over there. So that doesn't mean that the business will prosper. Maybe he's overconfident. Maybe he's trying to stop a sinking ship from sinking, but it will sink nevertheless. So don't overestimate the business, the management intention. Good intentions of management will not reverse a trend that is destiny. If the business is going down for whatever reason, you have strong, so keep that business management aspect separate. if the business is going to sink, you may only delay the sinking by having a promoter pledge his shares to get the money which is infused in the company on favorable terms toward the minority shareholders to save the company. Sure, that's a good sign, but that doesn't mean that it will save the company. So that's the perspective that I want to leave you with when you talk about the pledge part. But you're right that not all, you should not assume that because there's pledge, it's bad. You have to go deeper. As to management factors, a very critical part of the process of value investing, because you're minority investors, you're in the end handing over your money, or you own a stake in a business, and the business is in the possession of a team of managers who take all the capital allocation decisions and all the operating decisions, and their behavior will determine the outcome of the business, and the outcome of the business will determine the value of the business, and you only have an exit in the public market. So you're really totally under their control. So that's the nature of the game that you've gotten into, right? So we know that. So when you look at management, I like to have 3 different dimensions. And again, this comes from Warren Buffett. So he looks at 3 different dimensions, and they're all different, and they're all critically important, and all of them have to be present. The top one is operating skills. The second one is capital allocation skills, and third one is integrity. Now, on integrity, of course, there are shades of gray, and I don't want to go into that, but clearly, if you have a guy who is fantastic in operating skills and who is fantastic in capital allocation skills, but is a crooked fellow, you're not going to make any money with him or her. Integrity is important, and so I leave that part separately. But as to operating skills, again, you have to think about how well do they run their business. When you make that judgment, you have to look at the complexity of the business, the industry, how tough the industry is. If you are running an airline company, then you're not going to make the returns on capital that will be made by a poorly run but quite successful, well-established FMCG company. So you have to remember this, that you have to, when you evaluate operating skills, you have to evaluate it on the basis of the cards that they have been dealt. And part of the cards that are dealt are industry cards. You know what industry happen to be. It's a tough industry. Great managers will do worse than mediocre managers in great industries, in monopoly industries. That doesn't mean that the management was great. It just that a better manager could be in a tough industry. So in a tough industry, operating skills come out through markers in terms of returns on capital, balance sheet quality, margin profile, and so on. So you have to do a lot of peer analysis to find out who's the guy with the best operating skills. But the problem here is this is only first cut analysis. Some people are very greedy. You know, they're running a business where they can charge a price which is quite high from customers right now, but will also attract competition. So, you know, again, the question becomes whether you are a Jeff Bezos, an entrepreneur who wants to deter competition, or you want to be somebody who gives in to temptation of near-term easy money, and therefore don't care about or are not worried enough about potential competition coming in. So that's again another dimension on which you have to think about operating skills, merely because a high level of profitability right now compared to peer group may indicate a higher operating skill, but not always. There are exceptions. For example, if you're very greedy, you're overcharging for your product, it's only a matter of time and new competition will come in and will be a trouble for you going forward. And that on that dimension, then you will give a lower marks on the operating skills, right? Similarly, when it comes to capital allocation skills, you have to think about not just what the business will do, what the manager will do with the cash the business generates, whether you will pay it out as dividends, whether you will do stock buybacks, whether you will retain in the company, you will grow treasury, you will do CAPEX, you will do forward integration, backward integration, and geographical expansion. All these are capital allocation decisions, to be sure. And you have to look at it again from a point of view of the uncertainty that is inherent in capital allocation and the risk management methodology that the capital allocator has. So if a fellow is betting the bank on a single project, where almost a huge amount of cash flow and more borrowed capital is going to be invested in different projects. That's a decision, but it's a risky decision. So you have to think about capital allocation in terms of not just about the kind of decision that has been taken: forward integration, backward integration, geographical expansion, going into a new market, diversification, and so on, but also about whether there is a due process involved here. What will happen? Has he thought about the consequences of going wrong? What is the downside risk about this cap? Because that is what will become a misallocation of capital, right? When it blows up in your face, when you go and do some massive expansion in a different country about which you don't know anything, and you lay out a lot of capital for that, if it pays off, it does very well, look like a hero. But if it blows up in your face, then it will destroy the company. So that would be in your judgment before the outcome. You got to be able to figure out the process, and to understand the process, to think about the consequences of failure. So there are all these things that you have to consider when you think about management factors. So I'm not talking about integrity, but I talked about operating and capital allocation.
Thank you so much, sir, for quite an elaborate answer. It was wonderful. Moving to the next question, sir, we have Himanshu. So Himanshu is our alumni. He is presently working with Access Capital. Himanshu, maybe you can start with your question.
Yeah. Hello, sir. In one of your cover inefficiencies in market pricing to judge modes, emerging modes, you cover a point that market's inability to see emerging modes over a time. If you can elaborate this and give an example, and also show how give a framework how to detect it in the real life situation.
Yeah, I mean, I can give you many examples, but I mentioned this earlier. This came up earlier because the whole idea here is that business is moving from fragility to robustness over time. It is getting better over time. When you say a business is getting better over time, what does this really mean? It is not just about ROC. You may have actually a lower ROC but a better business. It's not. So a lot of people think that ROC has gone from 70% or 50% to 35%. 35% is fantastic, because cost of capital is 10, 11, 12%, and you have 35% ROC, and you put more capital behind that number. That spread is what creates wealth, not percentage. A street vendor outside your campus or your house selling chole bhature or vada pav or whatever has a very high ROCE, but he's never going to become very rich because he can't put a lot of capital behind that high ROCE. So the whole idea about businesses getting better and over time is it has something to do with ROC, but it's not the only thing to think about, or even ROE for that matter. So there are other dimensions. Are you moving from a weak balance sheet to a strong balance sheet? Are you moving from a huge customer concentration risk to a low customer concentration risk? Are you moving from a huge geographical concentration risk of having your manufacturing facilities or your service capabilities in one location to multiple locations? Do you have a country risk? Are you moving from one country to many other countries around the world as you have customers? Do you have a vendor concentration risk, a raw material concentration risk? I mean, how many things can go wrong that can impair your ability to do business? So as the list of things that can go wrong, which can impair your ability to do well in your business keeps going down, then you can clearly say the business is getting better over time. And these things don't happen in a day. They take time. And simply because they take time and things are getting slightly better, it is like the boiling frog. Slow changes do tend to go unnoticed. It won't show up in quarterly numbers, but it will show up if you look at the numbers, the cash flow statement or the balance sheet or the P&L 10 years ago, 5 years ago, and today. I think that is what I meant. So there are these markers. You can talk about examples. There could be improvement in margin profile. There could be unit volume growth and market share growth. There could be entry into new markets. One of the things about entry into new markets is that a prosperous business which is only operating in one part of the country suddenly decides to move into other markets. Now, I'll give you an example here. Again, it's a company that I've cited in my classes in the past, and I'll give you an example. Take a look at V-Guard. It's an electric appliance manufacturer based out of Kerala. It's very dominant in the South Indian market. Has now gradually trying to sell its V-Guard products in central India and northern India and other parts of the country. But think about this for a moment. If you are a well-known brand in South India, then you can obviously charge higher price than other brands. And of course, if you are appointing distributors and dealers, you will give them terms that are very different from terms that you will give to new distributors and new dealers if you're entering into the North Indian market, because you're an unknown player in North India. You will open branches, you will open stores, and you will open distribution channels. So the price that you will charge for your end product will be maybe lower than what it is charged in your most profitable part of the country, which is South India right now. So effectively, your South Indian market will subsidize the North Indian market for a while. But if you are right about this, if your strategy is right, then over a period of time, the brand will become recognized, the pricing power will there, the discounts that you're giving in the new market will be lower than or will be non-existent, and the terms with dealers and distributors in terms of the margin that you give to them, in terms of the credit that you give to them, and so on, will also improve and become similar to what you are doing in South India. If that happens, then you're going to see improvement over time. So the point is that when you are going into a new market, you have to recognize that businesses don't become better in a single day. It's a strategy. It's a strategic decision to go into a new market. Whether it will work or not is unknown right now, but there is a logic behind it. And you have to monitor whether it is playing out or not. And maybe it will take more time to play out than what was envisaged by the original entrepreneur and by the stockholders as well. These things happen all the time. You almost always overestimate the good outcomes in terms of timing. Good things happen and happen in large degrees, but they may take much longer than what you originally anticipated. So with that perspective, you have to look at what is the strategy. And in this sense, it makes a lot of sense for me to read the MDA section of the annual reports of the letter of to the stockholders as to what is the strategy, what are they trying to do? Are they moving from fragility towards robustness? And not just what they are saying, but what they're actually doing. Are they following through? Do the numbers validate the thinking? In some cases, the numbers actually don't validate the talk. The strategy looks fantastic, but it's not playing out. And you got to be able to connect the dots between what the management is saying, what the strategy is, does it make sense, and whether it is actually transpiring into reality or not. That's what the entire thing about the business analysis is about.
Thank you so much, sir, for the answer. Sir, actually, your one sentence, like finding out what could possibly go wrong with the business, gave me a jog down the memory lane. So, guys, we had privilege of hosting Sanjay sir 4 years back as well, and Prateek and I had the privilege of hosting him for a dinner after the session. And sir, that 2-hour session, along with dinner, changed our lives, because we remember we asked you one thing, sir, what could we do to improve? And you asked us that make a list, what could possibly go wrong with you guys, and start working on that. And sir, that dinner changed our lives. So 4 years later, literally, I can tell you, this answer gave us, I literally had the goosebumps. So thank you so much, sir, for that dinner and for that wonderful piece of advice. It genuinely changed our lives.
Oh, you're welcome. I'm glad.
So moving to the next question from Amatullah. So Amatullah is our Finbridge batch student. Amatullah, maybe you can ask your one question.
Yes. Good evening.
Yeah.
Sir, in Bhav Bhagwan's video, you explained that when the market is giving the company high valuations, the company should issue equity, even if they don't need the cash at that time. But what if the company is all set for now and not looking for expansion or capex for some time? Wouldn't the accumulation of cash, not utilizing it or utilizing just for sustaining the business, would lead to decline in the fundamental value of the business due to depressed ROE and ROICs in the market? Also, sometimes won't it encourage the managers to do some unrelated diversification, which would be bad for business or its reputation?
I did a video lecture on this subject called The Value of Cash. It's on there on Vimeo. You can look at that. Basically, what I said was that cash is not that easy to value. We think we just take the value of cash and plug it into our valuation models, but it's not that easy, because cash in the hands of a right kind of entrepreneur is worth more than the value of cash. Where if you give it to a dumb person, then it's worth less than the book value of that cash, right? So now, as to I also just now talked about ROC and ROE, and not trying to maximize them, but trying to maximize the capital that can be invested on the spread between ROCE and cost of capital. And for that, you may have to accept projects which have a much lower ROCE, but still well above the going rate for bonds and so on. And therefore, that you have the ability to grow the business and still earn incremental returns on capital that are enticing, that will create wealth for the stockholders in the long run. So I'm not impressed about the idea of very high ROEs and ROCEs, although they should be high enough and large enough in relation to AAA bond yields. So that part is well taken. As to what cash does, if you have a lot of cash on your balance sheet, whether you've raised it opportunistically from the market, or whether it's just free cash flow that the business has generated and not yet been distributed to stockholders and just sitting there, at the end of the day, that cash will increase the denominator in the ROC. The way I think about it is that there are two parts of the cash of the balance sheet. One is the operating asset, one is the non-operating asset. If the cash is access to the current needs of the business, does that make it a non-operating asset? A lot of people think it does. I don't think so. It's just future operating asset, but just lying over there right now. So if there is a large prospect that this cash, which is lying on the balance sheet and penalizing the ROCE the way it is traditionally calculated, because the money that the cash earns is treasury income, which is very low compared to what the operating business earns, which could be 30%, 40% ROCE on operating assets. Then by adding more and more cash to the balance sheet, you bring down the ROCE. But I'm not so worried about that, so long as that cash will ultimately become more operating assets. You see, the decision as to when to set up a new plant, when to go for more expansion, is a judgment that the entrepreneur has to make based on size of the market, how it is growing, when he will run out of capacity, when does he want to add more capacity, and so on and so forth. And if the track record of the entrepreneur is exceptional, then why should you have a problem worrying about cash which is lying on the balance sheet? It's just not the right time to invest. He can give it back to you as dividend and do a rights issue, but that's an inefficient way of doing things. Might as well keep the cash on the balance sheet, so long as it becomes fixed assets and working capital, which will grow the business over a period of time and create good quality growth. As investors, we should not have any problem whatsoever. The problem does occur when they just hoard cash for the sake of hoarding it and have no intention of returning to the stockholders and will not even use it to grow the business. And there, the intention of the management becomes apparent over a period of time, that they don't want to share the wealth. They just want to hoard it in the company, and therefore the market figure that out over a period of time and give it appropriate valuation. So I think it's important to make that distinction between cash which is on the balance sheet for a temporary period versus cash which is there on a permanent reasons for ulterior motives of the management, which will never add value to the stockholders.
So just a follow-up question on that. What if, so an example which came to our mind was Bajaj Auto. Like, for example, like they have ample amount of, and they haven't really been doing much of CAPEX on that front. Like, not actually per se from a stock perspective, but what if you come across a business, something like this? How do you take a look at that?
So, but I don't want to talk about specific businesses, but basically Bajaj Auto problem is not a new problem. In fact, they had to pay out cash after shareholder revolt many years ago, because the joke became in the investment community that they also make scooters. And those days they used to make scooters and not motorcycles, because they had all this cash and this was a hugely profitable business, virtually a monopoly. And they did not send the cash. You see, you got to understand the psyche of the person who's running the company. You see, he's in control and he has an independent mind, and this is his attitude towards this particular decision. I mean, take MRF, how much dividend do they pay on a per share basis compared to the stock price? This is their view. It has been known. It's nothing new. It's not like he has become like he or people who run the company today now, and even the early generation, have become suddenly different from what they were before. They've always been like that. And they've been extraordinarily conservative in the way they will allocate capital. They may have gone right, they have gone wrong. You may have your own thoughts on that, whether they've made all the judgments about getting out of a segment, getting into a segment, not investing in a certain technology, or investing, whether they're early or whether they're late. You see, all these are your judgments, your thoughts, and this could have been done, but you are not running the company, right? They are. So it's always up to you to decide whether you like it or not. And it's not easy to put yourself in the shoes of the entrepreneur. The entrepreneur always wants to protect the company. For them, creating stockholder value is important, but it's not a key factor here. So for them, cash is an asset that protects the company from all sorts of things that can go wrong. And in the current environment in the two-wheeler industry, the biggest threat that the entrenched players face is obviously that of technological obsolescence, and they have a reasonable justification of holding on to the cash because they need the money to set up new kinds of technology to build electric vehicles. And they might have to spend a lot of money doing that because the old technology is going to go away. If that's the view that they come to, even reluctantly, even too late, then their decision to hold cash is something that you have to consider. There's a logic behind it, right? So you may not like it, and therefore you always have the choice of not buying the stock. But it is what it is. It is the decision. It is the nature of the management of being extraordinarily conservative, and people are like that. On the other hand, you have people who are borrowing money recklessly and are spending money like crazy in acquisitions, and there are groups who are doing that. So there is the other extreme as well. So you're going to have both these kinds of people, and then you have people in the middle who are opportunistic, who are conservative, who are also aggressive, but never so aggressive that things don't work out well, will blow up the company. So, my preference is for the guys in the middle here. So, it's up to you as to what you prefer.
Got it, sir. Thank you so much, sir, for the answer. Sir, moving to the next question, please proceed with your question.
So, good evening, sir. So, my question was that as per one of your blog posts, you wrote one should seek higher return to compensate for additional risk that leverage adds. How should we see leverage as? What if the company is a growing company? Like if it is a growing company and it has enough growth potential, so how do we see as leverage as?
Okay, leverage is a very interesting concept. And a lot of people think of it as only borrowed capital, but that's not the only explanation, meaning of it. Leverage basically means other people's money. Float is leverage, right? In that sense, Berkshire Hathaway is one of the most levered companies in the world because they have access to so much of other people's money, but the terms of that money are very favorable to Berkshire Hathaway and its stockholders. Why? Because you don't have to put up collateral, and you don't have to pay any interest on that money, and you don't have to return it tomorrow. It's there for a long time. So those three attributes turns other people's money into a very favorable form of financing, and it has impact. And I wrote about it in floats and moats and all, talked about, given many lectures on that subject. The point I'm trying to mention this here is that don't think leverage is bad. When asset management company which is running all these mutual funds, that's leverage, right? Although the AMC has no debt, but it has huge leverage because it is managing other people's money and they get fees from that money, and it makes the business extremely profitable. It's the access, is the ability to manage other people's money in very large quantities, which makes them extremely profitable. But because of leverage, because they have access to other people's money. So think of leverage as a much more broader concept. Even debt-free companies could have leverage in that sense. So I'm just trying to make the point here that leverage is a much more broader and interesting concept than what is normally associated with, because leverage, people say, oh, all leverage is bad. Not all leverage is bad. Some leverage is extraordinarily important for you to do well in life. So that was one part. Not about financial leverage, which means the worst kind of borrowing is short-term borrowing, which has to be paid tomorrow and has no, basically because it's short-term, if interest rates go up, your cost of borrowing also goes up. And you have to give a lot of collateral and secured and all that. So that's the, if you combine that kind of leverage with very high growth in a business, then those are two sort of chemicals which tend to create explosions. If you look at almost all large-scale bankruptcies in the non-financial space, I'm talking about financial space, levered companies, lending operations separately, but even if you look at non-financial businesses which have blown up, almost always you will see a combination of very high growth and huge amount of financial leverage, which was structured not favorably as compared to what float is structured in Berkshire Hathaway. I mean, you only have to look at the graveyard. I don't have to name names here. Similarly, if you look at levered financial businesses, the graveyard is full of businesses and banks and lending operations, NBFCs, which has blown up. Only in the last few years, so many banks have shut down. Again, you see the same combination that they were growing very rapidly and they had this leverage. And because you have growth, you have incentives to keep growing the business. There is a tendency to relax your underwriting standards, your lending standards, because otherwise, how will you grow? If you have to grow a bank or an NBFC very rapidly, the only way you can do that is by growing the asset book, right? And if you're operating in a competitive market, you're trying to lend money to people and you want to grow very rapidly, there is this temptation to lend money to people who will not pay you back and basically take credit risks that are unwarranted. So you make that mistake. Or the other temptation is that you're lending money long term, which earns a higher rate of interest, but you're financing it with short-term debt, which is where interest rates are much lower because yield curve tends to trend upwards. Short-term interest rates are lower than long-term interest rates. So you're borrowing short and lending long, and so long as it works out very well, you have an asset liability mismatch, but it can play havoc because when your short-term debt is maturing, you are not paying it from the money that is coming in from the lenders who are servicing their loans, but primarily from new short-term debt that you are raising. So if that cycle breaks for whatever reason, it happened with India Bulls, it happened with so many companies, so many banks and businesses. It happened with Lehman Brothers in the US, it happened with Bear Stearns. So you'll see that a lot, that you have asset liability mismatch and you have very high growth and you have certainly fear in the minds of the lenders to you that you are not good credit anymore. And that's enough, like oxygen disappears on you and your debt in just a very short while. So in terms of, so any way you look at it, when you combine financial leverage with high growth, they are sort of deadly combination. So, I see that as a very strong source of agility. So if I'm investing in a levered business and I want to make sure that there is very little asset liability mismatch, if at all, and the structure of the debt is not unfavorable. Of course, I'm not going to get what Buffett has got in Berkshire Hathaway, but I'm not averse to leverage. I want to get paid for it. and I want the structure of the debt to be such that it won't destroy the company. And of course, I also think about how much levered businesses should be there in the portfolio, because as a class, levered financial leverage businesses are riskier than debt-free companies. Yeah.
Thank you so much, sir, for the answer. Sir, the next in queue we have Yash Tanna. He's our alumni currently working with Balaji sir, Shamsekar sir at I Thought PMS. Yash, maybe you can start.
Yeah, sure, sir. I'll take my first question. So it's about on the blog that you've written on circle of competence. So you have highlighted the relation between circle of competence and cost of capital. My question is, now in the industry, everyone would be having a different circle of competence, right? And hence everyone will have a different cost of capital. But ultimately, there's only one common ground in the industry where everyone is competing. Even in spite of having different costs of capital, there's only one single ground for competition. So how do we deal with this in the real world?
Well, the point was that there is this concept of envy. Basically, if you look at modern finance theory, it tells you to calculate cost of capital based on WACC, and then there is this cost of equity capital, which has a beta as one of the components. And the way you calculate beta basically requires you to think about the overall market, which is not your area of competence. So basically the point, this is again from Charlie Munger and Warren Buffett philosophy, that when you are thinking about the relative attractiveness or otherwise of opportunities, you only have to think about opportunities that you are capable of handling. So I don't do startups, I don't do IPOs, and I don't do a whole lot of things. But there are things that I can do and things that I could have done, but I didn't do. If the things that I could have done, but I didn't do, did extraordinarily well, that's my cost. That's my opportunity cost, right? So opportunity cost is very important. But when you talk about opportunity cost, is basically talking about what you could have done, but you did not do. But if you couldn't have done it in the first place, because it was outside the circle of competence, then how could it become part of opportunity cost? So in that philosophical point of view, on a very personal level, your own opportunity costs are based on your circle of competence. Things that you could never have done are never part of the opportunity set, right? You're never trying to do real estate pyramiding, you're not trying to do IPO, you're not trying to do a whole lot of things, right? So why should you bother if somebody does well in that space and makes a lot of money? It should not make you envious, and it should not bother you at all. You should only focus on what your circle of competence is. Now, obviously, you should also try to expand that circle, because circles are not static and they do expand hopefully over time as you gain experience and learn from direct and vicarious experience. So of course, the circle of competence idea itself also is not a static circle. It's a circle that should expand over time, which means that opportunity set should grow over time. And the other thing, as you talked about, common ground for industry, of course, you're right that at the economic level, at the level of the economy, all businesses are essentially in the capital allocation business. Whether you're a steel company or you're a company which is in making software or biscuits, they are, at the end of the day, all businesses are competing for capital. And as an allocator of capital, you as an investor have a choice. You're a capital allocator. You can allocate your money to a biscuit company. You can allocate your money to an airline company, to a paper stock, to a payments company. This is your choice. You are a capital allocator, and there are all these companies competing for your capital and that of all the investors out there. And the markets are putting a price on that capital. And one quick way of thinking about is the PE multiple. The higher the PE multiple, the lower the cost of equity capital of that company, right? Because the higher it goes, the cheaper the capital becomes. And of course, markets are not always right. Markets are often wrong, and there are huge dislocations in market valuations. There are huge discrepancies between how markets tend to value certain businesses because of fads and fashions and over optimism, and how some other businesses which are out of fashion but still very solid tend to get low valuations. Of course, then capital is shifting towards businesses that are highly valued. and away from businesses that are low valued. But that doesn't mean that the markets are always going to be right. So you're right. So to answer your question, the idea of cost of capital and circle of competence and capital allocation, they're all intricately linked. But when you think about circle of competence, it's the personal, it's on the personal level. Your own opportunity cost, your own circle of competence, and how you think about relative opportunities and what works for you and what doesn't work for you. If things don't are totally out of your understanding, don't do them and don't worry about what happens in that space. But when it comes to the level of the economy, you have to recognize that all businesses are competing for capital, and stupid valuations will lead to misallocation of capital at the economic level.
Got it. So thank you. That explained it very well. And so just one thing, I'm not going to ask the second question, but the article on Relaxo was excellent. So I just enjoyed reading that a lot.
Thank you so much, sir. Sir, the next question was from Preet Jain, who is our Finbridge student, but I believe the crux has already been covered in the previous answer. So we are going to move to the next one, to Ruchit. Ruchit is our FinPlus program student. Ruchit, maybe you can begin with your question.
Hi, sir. Good evening, sir.
Hi, Ruchit.
Yeah, sir, my question was like, for the traders, they do have a defense mechanism known as stop loss. So like for value investors, what kind of strategy would you suggest, or would you suggest so that they can safeguard themselves from potential losses? If we see a dip in the prices and we are in love with the idea of the stock or with the company, we may see it as an opportunity to buy more or increase a position, and which might in the future, the stock might go down the price. So what would you suggest for a long-term value investor, and would the anti-goals framework be an answer to it?
So I think we can learn from traders, because successful traders have one attribute, they don't have any commitment bias. They're not married to their positions like a lot of value investors. So if something is not working out, they get out. I'm not saying that all value investors should do exactly what all traders do, but there is something to be learned from the trading community, at least the successful traders, as to what kind of mindset they have, and they are more detached. They're less emotionally attached to any particular position. They're not attached to the position. You know that. So, and therefore, in that sense, I think they have more humility than many value investors who have this huge commitment bias towards their position. They're not detached. They're very much attached. They're married to these things. And they defend their positions, even in light of information or evidence that sort of challenges that. Now, one of the evidences that we end up seeing a lot, which challenges your hypothesis, is a drop in the stock price. Now obviously, if you believe in the whole idea of market inefficiency, then obviously you also mean to think that a lot of the stock price drops are unwarranted. But that doesn't mean that you should assume that all drops are unwarranted and you should indiscriminately go and average down on whatever you had bought at 100 has now become available at 50 or 40 or 30. You should buy more of it, because then you will be often end up catching a falling knife. So you have to exercise the humility that traders have to look at the position from a detached point of view and go deeper. You're neither right, I'm quoting Buffett here, you're neither right nor wrong because you agree with the market or disagree with the market. You're right because your data is right or your reasoning is right. So let's just take the idea of a drop in the stock price as a event. It's happened. So what you have to understand as to why it has happened. Is there some development which the market sees as a negative? Clearly that's the case, right? Which is why the stock price has come down. Is it warranted or not warranted? So that is a more difficult exercise, but one has to try to make an attempt in trying to figure that out, right? Because only if it is unwarranted, then you have a logic for averaging down. Otherwise, maybe it's the other way around, that if it is completely warranted and the stock is no longer of a business which you want to be invested in, you should maybe get out and accept that you were wrong. So humility is important, ability to see if there is a logic in the stock price drop is important. Giving it time is also important, in the sense that sometimes drops happen and they're unwarranted and you don't know, because there is some development, there is some event that has happened in the company, the market gets completely spooked and the price comes down, and then there is a clarification from credible sources about the nature of the problem. Clearly there's a problem, but the problem is not as bad as market thought, and maybe there's an opportunity over there. So again, I want to give an example of almost always, if you look at credit rating companies, they rely on information provided by the companies and the stock price behavior. And credit rating companies typically would never look at stock prices because they are credit analysts. They're looking at cash flow statements and leverage on the balance sheet and the terms of the debt, and they look at the information provided by the company in terms of how the business is doing, and so on and so forth. But they don't look at the stock price. But if you look at history, you'll find that every significant credit downgrade of a company, major frauds that happened in the recent past, the stock price decline was an early warning indicator for you, the credit analysts who had access to the management. Stock market is technically supposed to be working on the basis of outside passive minority investors who don't have access to inside information, and credit rating analysts have access to inside information. So the stock price decline should have told the credit rating analyst there's something wrong. And in fact, in the recent past, I have read some credit rating reports where analysts have actually said that the stock price decline is something that we are looking at, and we're going deeper into the reason as to why that has happened. Again, the point I'm making is, whether you're a stock analyst or a credit rating analyst, the fact that there has been a significant decline in the stock price, which is unrelated to overall market decline, is a data point for you to do some introspection and think about why it has happened. And maybe it has happened for good reasons, or maybe it has happened for bad reasons, and that will help you determine whether there's an opportunity here or there is the reason for you to lighten up on the position, or maybe even do nothing, because the price may have dropped to a level where even if the warranted problem has been more than compensated by the drop in the price, and maybe you should just sit on the stock and maybe you should add to that. So all these possibilities exist. The fact that the stock price has fallen doesn't mean that you have to buy automatically, doesn't mean that you have to hold on without any reason to go deeper into the situation, and nor does it mean that you should sell out. It has to be validated by more work and more analysis, and then only you can come to a reasoned judgment.
Thank you so much, sir. Sir, moving to the next one, Dhruv Rathod. He's presently our Finnish program student. Dhruv, you can quickly ask your question.
Thank you, sir, for this opportunity. Sir, my question was that in the Thomas Cook research paper, you emphasized a lot on scalability of that business. So would you rather spend time on businesses which have scale, or companies who can't scale at a very high rate but have a good margin, like gross margins, EBIT margins, etc.? So what's your take on that?
Let's look at how you make money in stock. You have a stock price today, and there's a stock price at which you sell 5 or 10 years down the road. And assuming that there are no new shares issued or stock buybacks, the number of shares is the same, the only way you can make money is because of growth in earnings, dividends that come out of that earnings, and the change in the P multiple. The P multiple may go from 20 to 30. The earnings growth may be 15% CAGR. You may get some dividends which keep growing over time because earnings are growing at a given dividend payout ratio. So those are the three components, right? Change in multiple, earnings growth, and dividend. So obviously, we live in a country which is growing, one of the fastest growing economies in the world. And we could have been living in a very stable economy, which is not growing very rapidly, but we are growing. And if you look at the long-term returns of almost all stocks out there which have done well, almost always earnings growth has been a very important component of that growth. And also it's the most friendly component of the growth because it's something that you can rely upon. It's something in your control. You can decide whether it will grow or not grow. Not that it will listen to your decision, but the point is at least you have some control in deciding whether this is a growth stock or not. But when it comes to multiple re-rating, it's totally out of your control because it is dependent on the behavior of other people. Deciding whether this is a growth company or not is your judgment. Whether the multiple will go from 20 PE today to 40 PE 5 years from now is not in your control. You may want it to happen. You may even think it's warranted, but whether it will happen or not, and whether it will happen on the time scale of 5 years or 10 years is totally out of your control. If it happens over 10 years, the CAGR will be different from if it happens over 5 years. So I feel that you want to be in situation where upward re-rating is warranted, but you can't predict when it will happen. But you want earnings growth. And if earnings growth alone, along with dividend return, gives you a return, aggregate return, expected return of a lot more than what you can get in a AAA bond on a pre-tax basis, then the re-rating that you want to happen should be treated like an icing on the cake. If it happens, great. If it doesn't happen, you still make money. That's a good position to be in, right? So in that sense, if you want earnings growth to be an important component of your investment return, because it's in your control to decide whether to invest in growth stock or not growth stock or shrinking companies, then you don't have to depend on P multiple re-rating so much. Although the P multiple re-rating also is a function of growth. If the business is proven to be a strong growth company and it is changing its character from a low growth company to a high growth company, then some re-rating is warranted. But you don't know whether it will happen or not, and you're not certain about it. But you're much more certain about earnings growth because you can clearly see the business model, you can see the trajectory, you can see how they are growing, you can see the size of the opportunity, you see the market share, you know the management capabilities, you know exactly what they are doing to go from 10 to 30 in the next 10 or 15 years. And therefore, you have a lot of confidence in that growth numbers than in the P multiple changes, which are warranted to be sure, but they're not in your hand. So in that sense, I give a lot of emphasis on the actual growth of the business. And again, I focus on good growth versus bad growth point that I mentioned earlier. If the growth is based on just pouring capital in a business which doesn't make economic sense, then that is not something which is charming. You want good growth in terms of incremental returns or incremental capital that are exciting, that are much above the AAA bond yields, even though they bring down the ROC, by the way, which I mentioned earlier. So that's what you're looking for. Earnings growth plus dividend growth plus a modest upward re-rating, if it gives you a fantastic return compared to AAA bond yields, and that's a very attractive combination to have.
So next question is from Yash Gandhi. He's our FinPlus program student. Yash.
Hi,
Yash.
Sanjay sir.
Hi,
Can you hear me? Hi,
yes.
thank you again for your time. And my question basically, sir, is that this is something that I've been personally struggling as well as an investor. People say that patience is very important and you should hold good stocks for long term, but then you are ultimately responsible
I can't hear you anymore.
We seem to
for your
have.
own capital, and sometimes good stocks. How do you? Sorry, hello.
Yeah, please continue, Yash.
Okay, no, basically, sir, how do you identify that you are actually not being like stubborn and you're actually reassessing whether your investment is good or not if it doesn't move for 3, 4, 5 years?
It's a real problem. If you notice, a few days ago, there was a report that Warren Buffett has finally sold out of Wells Fargo, a bank that he's owned for a long time, but which went through a massive scandal a few years ago, not just yesterday or last quarter, few years ago, involving more than 5,000 people. It was a massive governance issue, and a lot of people who follow Mr. Buffett, including me, wondered why has he not gotten out of it? He actually did eventually. So the point I want to make is that even somebody like him, who claims to be a patient investor, who tend to become stubborn over time because there is this massive commitment bias and endowment effect. Things that have worked out very well for you,
Right.
you already invested. So it is a real problem, and I don't have a really good answer to this problem. Whether it is 3 to 4. Graham had a very nice rule for it. I think it was 3 years or 5. I think it was 5 years or 3. I think it was 3 years. So he was doing statistical bargain hunting. He knew that some of the things that he is investing in will not work out. He wanted to minimize the losses on the things that don't work out. And he had basically from his own experience, he came up with a 3-year rule that if it does not do what I expect it to do in 3 years, I just sell it and replace it with something else, which is statistically cheap at this point in time, and just not be fuss over it too much. So he had a very simple criteria. In fact, it's laid out in, I think, one of his essays. But the point is that when you're investing in a business that you like and you like the management and you have done well in that business over a period of time, and then it hasn't done anything for 3 or 4 years, of course it pinches you, it hurts you. But if you again look at the history of true wealth creation in the true compounders, it helps to see that almost all of them had periods of 3, 4, 5, even longer periods of no return. If you look at Infosys from March 2000 for the next 10 years, I have this chart in one of my lectures. For a 10-year period, there was zero return because the valuation became extraordinarily high in the tech bubble of 1999-2000. The peak of that bubble, for the next 10 years, Infosys gave you a zero return. But the returns subsequently were large enough. If you look at the average return, is more than 25% CAGR for a very long period of time. Again, the question, and it's easy for me to cite an example. There are many examples where this wouldn't have worked out, right? But if you look at the history of true wealth creating companies, the ones which have created the maximum wealth, and if you look at the long-term stock price charts, you will find long periods of time that would have tired out a whole lot of investors who got out. And this is exactly the problem with equity investing, that patience is a virtue which is going to be tested. The stock is almost certainly trying to test your patience. And tragically, for many people, they sell out and the stock starts going up right after they sold out. So there is this tendency to tire you out of 3, 4 years, and therefore, and you don't know whether this is a value trap or it's just a pause. It's just a relaxation time for the stock, and it's only a matter of time and when things will start looking well. The only way to deal with that is to see as to what is happening to the actual fundamental exhibit of the company. Is the business getting better over time? Was it really overvalued? Has the multiple, if the stock has not gone anywhere, if the earnings are going up, the multiple is coming down year after year. Is it becoming cheap? Is it becoming attractive? Or is none of those things are happening? So sometimes the stock doesn't go anywhere and the earnings also don't go anywhere, and you know that you got into a value trap. But if earning trajectory is solid and is getting better over time, and the business is becoming more robust from being fragile, and if the stock is not doing anything, then that's the nature of the stock market. You have to wait it out.
Okay, got it. Thank you.
Thank you so much, sir. Last question we have from Paras Doshi. He is our Finnish program student. Paras.
Hello, sir. Thank you, sir. And sorry, sir, for keep you waiting. I'll take the second question. Sir, from my article, what happens when you don't buy quality? You explain two schools of thought. One is mean reversion and second one is momentum. How should we build a portfolio wherein we give equal? Should we build a portfolio with both the school of thoughts, and what should be the weightage and the process of the building the portfolio?
Again, that's a question which really doesn't have a right answer. It's not physics, right? Both approaches work. You can decide to be purely a mean reversion investor. I know some of them were extremely successful who do just that. Or you can be a fundamental momentum investor in quality stocks or businesses that will grow their earnings year after year and will be worth a lot more money 10 years from now than they are right now. Both approaches work, and you can decide to be exclusively in mean reversion, exclusively in momentum, or some combination. It totally is your call. There is no right answer to this question. Both approaches are valid ways of investing.
Right. Thank you so much, sir. One last question from our faculty front. Prateek would like to ask that question. Prateek.
Hi, Sanjay sir. Am I audible?
Prateek.
So after 4 years back.
Yeah.
Thank you so much, sir, for allowing us the session.
You're welcome.
Sir, I would just like to ask the last question, sir. One crucial life-changing advice that you would have got, that you would like to share with our students, especially that will help them at this young age.
So I'll combine this with the last but one question. So I'll just answer two questions. The one is the one you asked, and one is prior to that is the question which I have a list of. A question says, what mistakes did you commit in the initial years of your career and life that you would want this young generation to avoid? Let me answer that question first. See, the thing is that I don't want you to not make mistakes, because mistakes have a very important role in shaping you. So you have to make mistakes, and I cannot prevent you from making mistakes, even big mistakes. Because only when you get burned a few times, then you learn that this is not the way to do it. So you won't do it unless you're burned a few times. But things that burned me a few times, I can tell you, whether you will follow it or not is one thing. It's a separate thing. That what I learned to avoid by doing this over and over again and realizing that I don't want to do it again. One is F and O. No F and O. Second is LAS, loan against shares, no leverage. And the third is television, no television. I've gone wrong enough to watch TV and make judgments about what to buy and what to sell, and sometimes lost, in the early period, huge amounts of money. So these are three things that I would ask the generation, the current young generation, to avoid if they can. But again, even if you don't, you will figure it out on your own by getting burned a few times. And the last question that Prateek you asked me was about crucial life-changing advice that I got now that I got and I would like to share. So one is from Seneca, and recent past I talked about it, the value of time. Time is the only thing you can never make back. You can make back everything. You can screw up a relationship with the person and hope to make it back by apologizing. You can lose money and you can make it back, hopefully, by fixing your errors and hoping to get lucky over time. But you can, no matter what, you can never recover lost time. So be very careful about the time that you spend. Who do you allocate it to? What activities you allocate it to? What is important to you and what is not? Because it's not going to come back. So it matters. That is one. The other one is the power of focus, intense focus, and less distractions. And you can do a lot by intensely focus on one idea and one idea. I'm not talking about idea in terms of investing, but I'm talking about thinking process. If you're thinking about, like I talked about leverage today. Leverage is a very fascinating concept. To think about leverage for the next 2 days and ask what is good, what is bad, what is financial leverage, what is operating leverage, what is float. You will not find a single location to find all these thoughts put together, but you have focus and you have intensity and you have time, and you give time to that particular thought, you will come up with a wonderful ideas as to how to think about a certain topic. So it could be anything, but the focus, intense focus with no distraction, is one of the most important things that I learned in my life. And of course, there are all these distractions in the world of social media. I'm not saying don't do it, but find time every day of intense focus, even for a few minutes, even for half an hour or 1 hour, where you don't have any of those distractions, and you will really learn to appreciate how important this is in the long run.
Thank you so much, sir. Thank you so much.
I know we are way over the time frame which we had discussed, a half hour over and above the 2 hours, and especially it's your fasting day. You literally took out time for 2.5 hours and spend time with us. So we are genuinely blessed. I still hope that you'd give us an opportunity in near future as well. Once again, bless us with your learnings. And the piece of advice which you gave us 4 years back, it changed us. It gave us focus, it gave us a purpose. And we, as a key takeaway from today's session, the last but point, as Charlie Munger said, take a simple thing and take it seriously. Something which we are going to definitely focus on and move forward as a learning exercise from today's session, sir. So thank you so much. We will not take any further time from your calendar. And we apologize to your family as well to have kept them waiting and to have kept them waiting.
Thanks, Shailesh, and thanks, Prateek, and thank you all of you to come here. And by the way, the quality of the question is excellent. You guys have really spent a lot of time going through a lot of the material that I published over the years and asked me some very penetrating questions on that. So I was very impressed with the quality of the questions. Apologies, I could not answer all of them, but it was fun to do this.
So thank you so much for going overboard as given the time frame. Thank you so much, sir.
Thank you. Thanks.
Thank you so much.
Bye, everybody. Thanks. Bye.